Hi everyone, good morning. Today we are going to start with leverage buyout, uh, episode 29. My name is Deepak Bisht. Previously we have covered question number 1 to 6. Today we are going to cover question number 7 onwards. So let's get started. Question number 7 is about a real life example of an LBO model. So if I were to give you a real life analogy of LBO is about So it will be about purchasing a property using a mortgage. So it maps well to how private equity firms use debt to amplify returns. So the first point here would be about your down payment. So down payment would equal to equity contribution. When you buy a rental property, you typically put in portions of the purchase price upfront. And in an LBO, the private equity firm does the same and contributing a relatively small amount of equity compared to the total deal value. So the total down payment would be an equity contribution. The mortgage would be equal to the leveraged debt financing because most of the property cost is funded with mortgages from the bank. And similarly, in an LBO, the majority of the purchase price is financed through various layers of debt. Uh, The third would be income, personal income or rent. Personal rent from tenants would be equal to, or personal income would be equal to operating cash flow for the business. So you use a rental income to pay your mortgages, interest or payments. So in an LBO, the company's operating flows, cash flows are used to service the debt, the interest first, then the amortization. Renovation or operational improvements would be equal to value creation or EBITDA growth because it is if you upgrade the property, renovation or renovate the units, add amenities, improve management, the property becomes more valuable and rent can increase. Rent or the personal income can increase. So in an LBO, the private equity firm improves the operations to grow EBITDA and boost the company's valuation and the paying down the mortgage over time is known as deleveraging. So as the mortgage shrink, your equity in the property grows. And in an LBO, the debt payout increases the sponsor's equity value because the enterprise value is split over less outstanding debt. And selling your house or selling the property is known as the exit or the sale of IPO. So when you actually sell the property for more than you bought it, the proceeds pay off the remaining mortgages and the leftover cash is profit. So this mirrors an LBO exit, where the private equity firm sells the business or takes it publicly and repays the debt and keeps the equity gains. So in this is a strong analogy because it highlights the role of leverage. It explains how cash flow supports debt, and it shows how value is created. Plus, deleveraging drive returns. It's intuitive and relatable for investors. So one more time, I would like to talk about the pointers. So you are the when you are paying down the debt, the down payment, that's equity contribution, which is here. The second point would be the mortgage. Mortgage is equal to the leverage debt financing. The third point is the income. So you are generating income now. So you actually control the property. So you are generating income. So personal income or rent which you are using to repay the loan is known as the operating cash flow of the business. And in between, when you renovate or there is an operational improvement in the property, it will create value. It will create value and EBITDA growth. Um, and paying down the mortgage over time is known as deleveraging. So we are paying down our mortgage throughout time, and selling the property is equal to the exit or the sale or the IPO. So if you look at a properties from if you look at this from a properties perspective, we have covered everything, which is a real life example of an LBO, which mimics a real life example of an LBO. I hope this is actually helpful. So let's move to question number 8. So question number 8 is it's a very great question, I would say. So question is about, can you explain how the balance sheet is adjusted in the leverage buyout model? And to start with liabilities and equity side, the first step would be to add the debt. So let me just show you my Excel. I'm sharing my Excel with you. There is an hypothetical example. I am assuming that we have purchased a company for $1,000. These are all dollar amounts. So I am assuming that we have purchased a company for $1,000, and that portion was $600, and the sponsors equity and the management rollout to support the leverage buyout was $400. These terms we will discuss about these in detail later on. And we have acquired the company and we have used $50 of the company to support our uh, purchase of the to support our buyout. Old debt in the company was $100, and the book value of net assets was $400 when we acquired the company. PPE write-up was done by $50, and intangible assets were created of $150 of worth. And there was also a deferred tax liability from the write-ups, which was $60. So let's understand this question. So this is the example where we are discussing about the leverage buyout and how does the balance sheet looks like. So basically, if in simple terms, if we do not go to the example, there is going to be a difference in the cash equivalent, and there is going to be a difference in between the other tangibles. There is going to be a difference in between capitalized finance. We are using debt issuance cost and deferred financing fees, which we are going to put on the balance sheet because those are the those are the expenses which we are going to capitalize. And previously, we have discussed about the cost which we are the costs which cost we do we capitalize and which cost do we expenses out. And other adjustments are going to be write-ups and inventory step up, adjustment to DTA and DTL, and elimination of old goodwill. So old goodwill we will eliminate. And the other on the liability side, if we look at this, there is going to be different types of debt which we are going to raise. For simplicity, I have only taken one. And there is going to be deferred tax liability. Deferred tax liability will be created because of the step up. We have reevaluated the PPE on the current market value. So this will create a deferred tax liability on the balance sheet for us. And there is going to be equity. During a leverage buyout, so equity, yeah, it's sponsored equity contribution by by the team of the private equity firm and management rollover. So these are the contributions of equity. So in the hypothetical example, let's assume that previously there was $200 of cash on the balance sheet of the target company, and the PPE was $300. There was goodwill on the balance sheet of the company of $80, and other tangible assets inside the company were $50. So this will make a total of $630 of assets. And if we look at the previous balance sheet, there was $100 of old debt also on the balance sheet, and total liabilities were $100, and the shareholders' equity was previously $530. Uh, okay, so this gives us a $630 of total liabilities and shareholders' equity, and our balance sheet matches. Okay, so now, as per the question here, let's understand this thing. So we have a purchase price of $100, and the new debt raised was $600. So sponsors equity was 300 and $100, which we have plugged in here. So sponsored equity we have plugged in here. Excuse me. And sponsored equity we have plugged in here. The cash used by Target was $50. This means that our is reduced by $50. And if you can see, I have subtracted $50 from 200. This means our cash was reduced by $50. And yes, indeed, our cash reduced by $50. Okay, so after that, the cash was reduced by $50 to support our buyout because now we own the company, we can use the cash. The old debt was $100. The old debt was $100 and the new debt was $400 because, okay, new debt was $600, sorry. So new debt was $600. So now the new debt is $600 and the old debt, previous debt was $100. I have subtracted the previous debt because we actually have to pay down the previous debt, and the new debt was $100, $600. So I have subtracted the previous debt, and this has given me an amount of $500. So I have paid off the previous debt, and my new debt is balanced now. It's only it's only $500. Okay. So now the book value of the net asset, this we will use to calculate our goodwill. And the PPE write-ups were done by $50. So PPE was written up here. The PPE is written by $50. So the PPE, I have written it down, written up from 300 to 350. And the DTL from the write-up, I have plugged in here. The DTF in the from the write-up was $60. So I have plugged all these numbers here. Intangible numbers increased by 150. I have it plugged it here. Intangible previously was 50 and now it's 200. So I have plugged in here. I have adjusted it as per the. Uh, so I have actually adjusted it. I can add it up with the new intangible. So this way, now understand this thing. How do we calculate goodwill? And let me just show you one more time. I'm sharing my presentation with you guys one more time. So if you remember the goodwill calculation, the calculation of goodwill which we discussed previously, the goodwill was calculated using the equity purchase price. And this then we subtract the seller's book value. Then we add back the seller's existing goodwill. Then we add subtract the asset write-up. Then we subtract the assets, the seller's existing DTL. Then we add back the write-down of seller's DTA, and we add the newly created DTL. Okay, let me just show you this Excel one more time, and here we can discuss the formula. Okay, it's visible now. So if you look at the formula here, I have made the adjustments. So what I have done is I have subtract from the purchase price, I have subtracted, I have adjusted for the change in the previous goodwill. I have scratched it off. I have now added back the book and the asset value, the previous book value of the company. Then I have subtracted the PPE write up. Then I have added the intangible asset created. Then I have added the DTL from write ups. And I have subtracted everything from the purchase price, the new equity, the new price at which the goodwill is adjusted at. To the purchase price, I have from purchase price, I have adjusted everything. And this has created as a goodwill of $540. So basically, when we talk about the question here, I'm sharing the presentation here. So during this time, so we add the new debt, we replace the old shareholders equity, and then we adjust the asset side here. So first step is that we start with the liabilities and the equity section. We add the new debt here. We replace the old shareholders equity and we replace it by the we replace it by the sponsor's equity contribution, whatever the PE firm is investing, and the management rollover, if it's applicable. And on the asset side here, we actually do the cash is reduced, so we actually need to adjust the cash. Then there will be a creation of goodwill and other intangible assets. So because the purchase price is almost always above the book value of the net asset, the model plugs the differences as goodwill or the identifiable intangible assets. Then we capitalize the financing fee. So capitalize, we are going to capitalize the financing fee here because these are not expensed immediately. They are capitalized on the asset side because debt issuance cost and deferred financing fees, these are gradually amortized on the income statement. And other adjustments, which include the write-ups or the write-downs of PPE, inventory step-up, and adjustment to deferred tax assets and liabilities, and elimination of old goodwill, we put it on the asset side. And at the end, the overall an LBO is fundamentally actually the overall an LBO fundamentally changes the balance sheet debt. Uh, the so balance sheet actually what happens is the debt increases massively. So debt is going to increase massively because it's an LBO, leverage buyout, and leverage itself means debt. So equity shrinks only to sponsors' contribution or the management rollover, and asset size rises mostly because of the creation of goodwill from the purchase price. And after the transaction, the company is far more leveraged and focused on debt repayment once the leverage buyout is completed. And yes, if you ask me why the balance sheet doesn't match, yes, it's correct that the balance sheet doesn't match. The after balance sheet doesn't match because these are only transactional adjustments, not a full rebuild of the balance sheet. So we are only discussing about the transactional adjustments, not the full rebuild. And because of this, before and after LBO, total assets do not equal the total liabilities and equity. Uh, and after, the accounting reset was not complete inside the after view here. So old assets at fair value, we are so if we are when we after a leverage buyout, we actually have to adjust the previous balance sheet also. So a full post LBO balance sheet must include old assets at fair value, old liabilities, all new adjustments, and all new financing items, and elimination of old goodwill and new equity. I hope this just for theoretical purpose, I just wanted to share. So this is the first time we have actually calculated goodwill, and goodwill actually is calculated using equity purchase price, the $1,000. Then we subtracted the seller's book value, which was $400. Okay, let me just So the seller's book value, which was $400, then the seller's existing goodwill. So the seller's existing goodwill was equal to $80. We added it back. Then we subtracted the asset write-up. The asset write-up was the PPE write-up was by $50. And we subtracted the seller's existing DTL. So seller's existing DTL, there were no DTL previously, but after the leverage buyout, the DTL was $60, And uh, the write down from the seller's DTA and the newly created DTL. The newly created DTL was $60. We added it back. Then there was no previous DTL, so this was zero adjustment. And I hope this is clear. Though it's tricky and it is supposed to be tricky, leverage buyout is very tricky. But don't worry, once we will do an Excel on the leverage buyout, then it will be much more clear. Just remember the formula for goodwill calculation. Okay, so let's move to question number 9 now. Question number 9 is about uh, why are goodwill and other intangible assets created in a leverage buyout? So, goodwill and intangibles are created in a leverage buyout because the private equity firm always pay more than the book value of the company's net asset value. And under purchase accounting, you must reconcile the purchase price with the fair value of the assets acquired and liabilities assumed. And the difference show up as a goodwill or in identifiable intangibles. So the private equity firm pays a premium over book value, and companies really sell for their book value. They sell for a multiple of EBITDA, and reflecting which reflects a brand strength, customer loyalty, intellectual property, growth prospects also, and expected synergies or operational improvement. So the premium above the book value must be captured somewhere in the book balance sheet. Purchase accounting requires revaluing everything at a fair market value. In an leverage buyout, you must mark the required company's assets and liabilities at fair value. And usually, PP may be written up or down. Working capital may be adjusted, liabilities may change fair value. But even after these adjustments, the purchase price still exceeds the fair value of the net assets. Identifiable intangibles are recorded first. You separately record any identifiable intangible asset that can be valued and amortized, such as customer relationships, patents and technology, trademark and trade names, non-compete agreements. So these appear on the balance sheet as finite life intangibles. Uh, Goodwill is the residual after all intangible identifiable intangibles. So whenever whatever part of the purchase price cannot be attributed to identifiable assets become goodwill. So goodwill represents the value of the company's reputation, future expected cash flows that are not tied to specific assets, management team strength, going concern value. It is not amortized, it stays on the balance sheet unless impaired. In an LBO model, goodwill and intangibles also serve a practical purpose. They ensure the balance sheet balances. And once you add new debt and replace old equity with sponsor equity, the liabilities and equity side changes dramatically. And goodwill and intangibles plug the difference so that assets equal to liabilities split equity and after the transaction closes. So in short, goodwill and intangibles arise in a leverage buyout because the sponsor pays above the fair market value of the assets. And under purchase price accounting, that premium must be recorded on the asset side. And it's what allows the balance sheet to balance after the new LBO. New LBO capital structure is put in place. I hope this question is clear. Let's move to question number 10. Question number 10 is question number 10 is about we saw that the strategic acquirer may usually prefer to pay for another company in cash. If that's the case, why would a PE firm want to use debt in a leverage buyout? And this is actually a great question. A private equity firm uses debt in a leverage buyout because it's trying to maximize its equity returns over a relatively short holding period. And leverage reduces the amount of equity the sponsor needs to invest. It actually amplifies returns as the company pays down debt and shifts much of the risk onto the acquirer company rather than the private equity fund itself. So the first point here would be that private equity firms are return driven and operate on a short time horizon. Or also debt magnifies equity return, the core logic of an LBO. Debt sits on the company's balance sheet and not on the PE firm's balance sheet. So in an LBO, the debt is non-recourse to the PE firm, the PE fund. The company itself is responsible for interest and payment, principal repayments. If the company fails, the lender take the company, not the PE firm's other assets. This allows the PE firms to take on substantial leverage with the limited downside risk to the fund. And strategy acquirers cannot do this. The debt becomes their debt and affecting their credit rating, their balance sheet strengths, and their capital allocation goals. So they prefer to use cash. And also, debt enforces discipline and drives operational improvements. So, leverage forces the company to generate consistent cash flow, which aligns perfectly with the private equity playbook, which means grow EBITDA, and improve working capital and sell non-core assets. So, the debt creates pressure that actually helps the private equity firms increase efficiency and cash generation. And also, cash is scarce and expensive for private equity firm. As a strategic acquirer, you might have billions of excess cash or can issue equity, but private equity firms do not issue equity to the market. Their equity comes from the capital commitment. Every dollar of equity they put in is very expensive. Debt is cheaper and allow them to do more deals with the same funds. So ultimately, private equity firms prefer debt because it boosts the return, minimize the equity they must invest, and shifts risk to the acquirer company and fits their short-term cash flow focused investment model. Strategy acquirers have a completely different set of incentives, which is why they often prefer paying cash instead. So the main reason why a private equity firms prefer debt in an LBO model is that first is that the private equity firms are return driven and operate in a short time horizon. Second, the debt magnifies equity returns. The third is that the debt sits on the company's balance sheet, not on private equity firm's balance sheet. The fourth point here would be that the debt enforces discipline and drive operational improvement like cost cuts, uh, grow EBITDA, improve working capital, sell non-core assets. And the fifth point here is that the cash is scarce and expensive for the PE firm. So this was a good question. Let's move to question number 11 now. Question number 11 is, do you need to project all three statements in an LBO model? And are there any shortcuts? And yes, you don't always need to build a full three statement model for a LBO. The gap compliant way for an LBO is it's not a compliant way for an LBO. In practice, you need the minimum set of statements that allow you to project the cash flows and debt repayment accurately. And many bankers use shortcuts because the real goal in the LBO model is to understand returns, not produce perfect accounting. So what you must have to run an LBO, you need to track the pieces that affect the debt, cash generation, and return. So for that, we actually require a simplified income statement where we can generate revenue, EBITDA, EBIT, and interest expenses and net income, so that we can mainly project our EBITDA, calculate interest, and track taxes and net cash flows. Debt schedule, we need debt schedule because debt schedule is essential to calculate our interest expenses, mandatory amortization, optional repayment, cash available for pay down. And this is actually the heart of the LBO model. And simplified cash flow so that we can calculate cash flow from operations, capital expenditure, cash available for debt repayment. And if you think why do you don't need a full detailed balance sheet, because in many real life or real world LBOs, especially quick turn models, bankers avoid a full balance sheet because it's time consuming. Most line items do not affect debt pay down. The model's purpose is valuation, not accounting. And instead you use shortcuts such as assume assumptions for net working capital rather than projecting account receivable, account payable, and inventory individually. You simply assume that net working capital is a percentage of revenue or a flat dollar change each year. Uh, no detailed PPE roll forward because you can model capital expenditure and depreciation without recreating the entire PPE schedule. You don't, I mean, there is no need to balance assets because since the goal is returns, not audited financials, approximate balancing is sufficient in those cases. And when it would be a full three statement model is needed. So we will only need a three statement model when we are actually we are doing a detailed due diligence, want to analyze covenants compliance closely. If there are complex working capital swings in the model, or if we are evaluating liquidity risk or cash traps, or if we need to understand the deal's accounting impact, like PPA or deferred taxes, etc. This is typically done by I mean the buy side or in the full CIM model, not in the first round LBO. So you can absolutely run a functional LBO without a full balance sheet as long as you can project the cash flow, interest and debt pay down accurately. The LBO is fundamentally a cash flow and return model, not an accounting model. And we actually did saw this thing when we did our example. If you remember, if you have watched our introduction to the LBO series, episode 027, you will get why we do not need to forecast a full balance sheet for an LBO. So let's move to question number 12 now. So question number 12 is how do you determine how much debt can be raised in an LBO and how many tranches there would be? So debt capacity in an LBO is driven by the company's ability to service interest and mandatory amortization. This means that if a company cannot service its interest, then it's not profitable. And in practice, if you look at the market precedents, lender appetite, and the company's own cash flow profile to determine how much leverage is feasible and what type of debt instrument can be used, you will get a rough idea of that. So if we talk about it step by step, we need to start with market benchmarks. First, then we analyze the company's cash flow and coverage ratios. Then we consider business risk and asset base. We then determine the types and number of tranches based on the market condition, whether it will be senior secured loan, whether it would be subordinate or junior debt like mezzanine, PIK, and second lien, whether it would be high yield bonds. Then we will check lenders' feedback and syndication test. And lenders feedback and syndication test, in real deals sponsors actually test debt capacity. So early conversation with lenders regarding the leverage financing and the market surroundings and soft price talk and evaluation how easily the debt would syndicate is done. So ultimately, you determine the debt capacity by triangulating between market precedents, companies' ability to service debt, industry risk and characteristics, the real-time lender appetite also, and that determines both how much leverage is feasible and how many layers of debt the deal can support. So if we start with the market benchmarks, this means that we will look into the industry size and the business model. And we also look at the ratios like debt to EBITDA ratio, interest coverage ratios, and typically capital structures of the company. Then we analyze the company's cash flow and coverage ratio using interest coverage ratios, which is EBITDA, EBIT by interest expense, or EBITDA by cash interest. Then the other key metrics are fixed charge coverage and the free cash flow stability. We consider business risk and asset base, whether it's high leverage, software, healthcare, and services, have a steady cash flow, and low leverage means manufacturing, retail, commodity, and linked businesses because the cash flow is volatile. Asset heavy businesses may also allow secured revolvers, ABL financing, ABL facilities, or multiple senior tranches. Then we determine the types and number of tranches based on market conditions. The capital market dictates how you structure the debt. So senior secured debt is cheapest, usually 1 to 2 tranches, and term loan B common for sponsor-led LBOs. So for subordinate debts or junior debts, mezzanine, PIK, or second lien, it's added if additional leverage is needed. Higher coupon rate, often non-amortizing, and it's used selectively depending on the risk appetite. High yield bonds are also there, which are used for large deals. There is fixed coupon payment and flexible covenants. So, and the deal existence on these tranches depend on the deal size, credit market sentiment, and the investor's appetite. So in short, if usually you would look at a comparable LBO and see the terms of the debt and how many tranches each of them use. You would look at the companies in the similar size range and industry and use those criteria to determine the debt your company can raise. So I hope question number 12 is also clear. Let's move to question number 13 now. Question number 13 is about let's say we are analyzing how much debt a company can take on and what the terms of the debt should be. So, what are reasonable leverage and coverage ratios? Okay. So, reasonable leverage and coverage ratios depend heavily on the company's stability, cash profile, cash flow profile, and what the credit market are currently allowing. And in practice, you look at recent leverage loans and high yield issuance for comparable companies to determine what lenders are willing to underwrite. So, you start with the principle the cash flow dictates leverage means that the lenders care about one thing only. Can the company service its interest and mandatory payments in both good and bad years? So leverage levels must reflect cash flow stability, cyclicity, capital expenditure intensity, customer concentration, and margin on volatility. So a software business can support far more leverage than a manufacturing or a retail business. So second point would be realistic leverage ranges in today's market. While exact levels vary by cycle, reasonable interview numbers are low risk recurring revenue business in software as service and healthcare services. 5 to 7x of EBITDA to EBIT are common, sometimes higher for high quality assets. Mid-size, mid-risk means mid-risk steady cash flow business like industrial services, B2B or branded consumers. So 4 to 5.5x of debt to EBITDA ratio and often a mix of term loan A and B, possibly some mezzanine or high yield. Higher risk or cyclical businesses like manufacturing, retail, logistics, commodity linked. So there, 3 to 4.5x of EBIT, debt to EBITDA ratio are common, and lenders require lower leverage to absorb downside volatility. What you never see is no legitimate lender will underwrite uh, more than 8 to 9x of leverage in normal market. So 8 to 9x of leverage in normal markets, you will never see that. No situation exists where you lever a company at 30x or 50x EBITDA. Those are imaginary numbers. Don't overvalue any company. And those numbers are intentionally absurd to show how you understand the market reality. So these are trick questions. Don't fall into the trap of the interviewer. And coverage ratio benchmarks are interest coverage ratio, which is EBITDA by cash interest, and fixed charge coverage, which is EBITDA subtract EBITDA we minus capital expenditure and we divide it by interest and the required amortization. And lenders prefer 1.5x of the multiple for fixed charge coverage, and for interest coverage, lender prefer more than 2x, but they prefer 2.5 to 4x, which is common for a healthy leverage buyout. And where these ratios come from? So the debt comparables are to reason. I mean, if you talk about it, to determine exact levels for a specific deal, you would analyze the recent leverage loans issued in the sector, high yield bonds for similar credit quality, and leverage, interest pricing, amortization, and covenant packages. The mix of tranches also. So this tells you what the market will realistically accept. So reasonable leverage and coverage ratios come directly from comparable credit issuance and companies' cash flow resilience. Most LBOs fall in a range of 3 to 7x of leverage range, with interest coverage comfortably above 2%, 2x, but below 4x. And anything outside those ranges would be difficult to syndicate and unlikely to pass a lender security. So today we have covered question number 6 to question number 13 of the leverage buyout basic question series. Uh, question in the next session, we are going to start with question number 14 onwards. And with this, I would like to conclude today's session. Thank you for attending. I will see you soon.